kick things off with the rate cut. 200 basis point rate cuts to 11%. Like most analysts had predicted, were you in the same camp?
Well, we actually highlighted that the 200 basis points, especially with inflation numbers out not so long ago, was more likely than ever. So in that sense, yes, we were in that docket, even though some in the market would still feel it was on the higher end. The reality in terms of FX, in terms of rates, is that we believe that the market had already foreseen that or factored that in, and to us it is one more step into making it very clear that the policymakers are focusing on economic growth, and it is a welcome sign in terms of macro stability.
Indeed, a cut this time, and it's all about what's to happen at the next meeting. We know that this meeting was the last one for the year, so it's all about 2013 and the kind of direction that they will take in light of the elections as well.
Well, all I can say at this stage is that macro stability and economic growth are the forefront of their thinking, or at least if we judge by the action right now. And it is positive for the market. From where we stand, it's certainly positive for equity markets.
Let's talk about the equity market. I just wanted to ask you what kind of impact you see this cut having on the overall equity market going forward.
Well, our view is very simple. With the glide path in terms of interest rates being even clearer now, equities have become a better alternative in terms of asset allocation. What we want to highlight here is that macro stability and focus on economic growth is positive for corporate earnings in the mid or even long term, and therefore the equity market makes a lot of sense at this stage in terms of asset allocation and investment destination.
Looking at the banks that have released results, so we had KCB, Equity Bank and Diamond Trust Bank releasing some rather positive results over the past 2 days, a few days rather. Looking at those results, what did you make of it, and have we reached the top with some of these banks?
Well, the question here is that having been in a high interest rate environment, yes, with a sort of broadly flexible lending market in terms of rates, you could argue that we have seen the top. The reality going forward, however, is that we are in an environment where loan growth should be coming back, and the banks with sufficient capital should be able to mitigate any margin compression with stronger volume growth. It is also true that when you look at Q3 numbers in aggregate, they are slightly below Q2 numbers of this year. But some of the larger banks, KCB for instance, seem to be doing a better job at navigating the environment.
Let's just touch on the shilling. We know that it has been pretty stable of late, with the central bank coming into the market and mopping up through repurchase agreements. So what is your outlook for the shilling going forward?
Well, at this stage, we are still pretty much in a stable corridor. And we have heard a lot about some form of depreciation. I don't think that is I personally, at least, don't think that is the way forward. We feel that the market has embraced a certain level of stability, and central bank action seems to be speaking to that.